Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. How you doing today? I'm excited to be here. I don't know why. I like making these videos. I like teaching. We are financial advisors, and we like to teach our customers, right? I mean, what do financial advisors do on a daily basis? For us, we manage our own portfolios, and I want to share some of that interesting sort of research and stuff with you here. But also, we like to teach. Come on, you got to learn, right? Learn about your dough. Don't just give your money to somebody and then sit back and wait 20 years and see what happens. Make them teach you. How's it working? What's going on? What's all the good, like, geeky stuff in the background? Anyways, I got some geeky stuff to share with you here today. What we're going to do is talk about the stocks that are reporting earnings this week. It's not really earnings season, and I specifically waited to do this video for now. We only have a handful of stocks reporting earnings. And why do we care, right? I'm going to share with you a bunch of data here that looks rather interesting, but what's the point, right? So I want you to think about this. In the middle of earnings season, there could be as many as 150 stocks in a day, right? It goes in a wave there. But you could have 150 stocks in a day that report earnings. How are you supposed to research all that? Right? Which ones should you research? Which ones are good? Which ones are bad? How do you dissect all of that massive amount of information that's coming out to you? Well, the mutual fund managers do that, and that's actually my background, so I'm going to share with you how we do it. Here we go. Let's take a look. I'll just do it while we're sharing here so it doesn't seem like I'm teasing you. All right, we've got earnings, right? Cracker Barrel. A handful of names. Really, I highlighted Adobe and FedEx. Those are going to be the ones that get the attention this week because they're the bigger names, and FedEx is more of an economic bellwether and kind of tells us a lot about the economy, as well as obviously FedEx themselves. I would argue Adobe does the same, just on a smaller scale. I'll explain in a second. You've also got Cracker Barrel, a couple other names you'll recognize. Scholastic, remember those people that made you buy all those things in school when you had the book fair and stuff? Herman Miller, they make really expensive office furniture. And what I did is I put the date. All right, so we got 9/15, 9/16, 9/17. Very quiet week. That's it. There's really nothing else reporting earnings. This is the lesson today. They report on this day and everything. Here's the expected earnings. Okay, Cracker Barrel's expected to lose. Scholastic expected to lose. Revenues, here's all that coming into play. We don't really care about that right now. Number of reports, right? So what I wanted to do is just make sure we're not looking at a company that maybe has only reported earnings twice, right? So we got a long-standing list of companies here that have been around for a while. The data is based on this number of reports. The average earnings beat rate, you can see that Adobe does the best. They beat on earnings 89% of the time. They beat on revenue or sales 81% of the time. The worst is going to be Granite Construction. In the mix there. Is that the worst? Yeah, that's the worst. And you can just kind of look at that data. We've got guidance over here. That's important. These are the number of times the company raised guidance. Not a lot for all of these guys. And here's some of the more geeky stuff. Average gap on earnings day. So the stock that moves the most, the average gap here is Granite Construction. Second's going to be Scholastic, meaning it averages a gap down, right? So if it gapped up, that would be weird. It averages a gap down. Stay with me. Average percent change on the day of earnings, right? So accounting for everything, the gap and all of that good stuff. So what's interesting here is you can very quickly see if Scholastic averages a gap down of 1.14%, but it averages a loss of only 1.03%, what does that tell you? It tells you that the stock tends to gap down and get a little bit of buying throughout the day there. So kind of interesting. Same for Apogee here. These guys make like fancy glass and stuff. It's building construction products, but they make like fancy glass and stuff for if you want to make like a nice shower or something. So you got that there. You could look at Adobe. Averages a gap up 1.71%, and its average change is a little bit higher. So it tells you that when it gaps up, people are interested in buying that even more. And then off to the right, we got the average volatility in terms of which one's the most volatile. Apogee is the most volatile. FedEx is the least volatile there with a 4% range. Okay. Why do we want to know this, right? How are we supposed to pay attention to all this stuff? Well, what we're looking for, and a great example is here at Jazz, we manage our own portfolios. If you look at all of our portfolios, all the positions inside of every single one of them, we're darn near 1,000 positions. We're a small company. How are we supposed to watch 1,000 positions? Well, we're not watching 1,000. I like to, but we're not staring at 1,000 positions a day times all the customers that we have. We're looking for something that's odd. Right? And when something sticks out as odd statistically, then we go do further research. Here's my example. Let's say that Adobe normally beats on earnings, averages a beat, right? It averages a gap up. It averages a full day change. It's not so volatile compared to others. Now let's pretend that Adobe gaps down 5%. Is that normal? We have the data, this is all plugged into our software and everything, to go, hey, wait a minute, Dustin, you need to check this out. We own Adobe. We want to keep it. We like the stock. But if it gaps down 5%, we need to do further research and see if we want to weather that downturn or if we want to sell it. What could happen here? Adobe could report a decline in the, so they do cloud-based subscription services for their products. So let's say that they have a decline in the number of subscriptions that they have. What does that tell you? Well, Adobe makes products that people use to design products, create logos and stuff for new companies, make websites, adjust websites, make them more dynamic. It could be 3D modeling. There's all kinds of great things. Animations. Their software does so much. Audio effects and things like that. Photoshop you're familiar with. So if there's a decline in subscriptions, that might be bad for Adobe, and maybe it's just a blip in the bump in the road sort of thing. But maybe it means that there's not a lot of new businesses being started. Maybe it means that marketing departments have put things on hold a little bit. Maybe it means that all these companies that are just starting with animation and working with different companies, or the audio industry is maybe backing down a little bit. So there's a lot to learn from Adobe. So what we're looking for is something that's odd. If this normally does okay during earnings, if something stands out where it gaps down 5%, now that's the one we want to research. Think of the time that saves, right? If we own Cracker Barrel, the earnings are already expected to be poor. They're expected to lose. However, if you look at Cracker Barrel, I would argue that they've already priced that in. The stock's already recovering and basing sideways here. So if the stock, which on earnings, if the stock, which on earnings normally has a small gap, a slight positive day, kind of very quiet and everything. If that happens, we go, okay, everything's fine. We were right. They priced in a loss for the quarter. No big deal. You can continue to hold the stock, and barring any major surprise along the way, you wait till next quarter, you do the same thing. So you now can say, if I own the stock, is it going to do it? Oh, it's quiet on earnings. Great, we get to keep it. If it gaps down or gaps up a significant amount, now you've got to do some research. So you take your portfolio, go into something like that, and you go, okay, this is what we're expecting. Is anything odd? You could take it a step further. We love doing this. Here's the stock market. Here's the S&P every single day. If something seems odd, like let's say the day you're watching this is the 14th. Here we go. Average move in the stock market for September 14th is 0.21%. Give or take a little bit, that'd be a normal day. If it was better, okay, we're happy. But if something is really, really weak, then something's wrong. We need to do more research. And that's really why you analyze this stuff. This is why I share so much data with you. It's not market timing. It's not so you can go place a short-term trade. I mean, it's great if it works out, but that's not the goal. The goal is to say, I own a mutual fund, and inside the mutual fund is all these positions. You think the mutual fund managers there every day staring at these positions? They are, by the way. But, you know, are they really watching everything? No. What they're waiting for is all their data to show them something that's odd. Then they research that stock. They look for something to be a little bit odd and maybe add to the position or get out of the position. That is why we look at all of this data, and that is why I share it with you. Anyways, went a little long on this one. I just wanted to share some of that geeky stuff with you. I hope this helps. I hope you learned something. And, you know, hey, check us out at jazzwealth.com, all that good marketing stuff. I will move on from here. Have a great rest of your day, and thank you so much for watching. Will you hit the subscribe button? You do a thing. They tell me this number that we're almost to 100,000 subscribers. That'd be so cool. I'm just a normal dude that likes to make videos. If we got to 100,000 subscribers, well, I don't even know, man. That's too cool. So if you would, hit the subscribe button. You can turn the bell off if you don't want me to bother you all the time. We make a lot of videos. But enjoy the rest of your day, and thank you so much for your support.